The Federal Reserve has declared war on your savings. And that's what I want to talk to you about today. There was a historic announcement yesterday by Fed Chairman Jay Powell. And, I'm not sure how many people kind of follow that stuff. I'm a bit of a nerd of this stuff because it matters. And so I follow it. And, that's what I want to talk about today. They have said that they're looking to have average inflation of 2%. Okay, that might not sound like a big deal, but it is, and that's really what I want to talk to you about. Before I get into that, just a reminder that this Sunday between 2 p.m. and 5 p.m., I'm doing that financial seminar. So I've included obviously the link in this email, but highly encourage you to be part of that. I'll be discussing a bunch of these things, but really trying to get you set up going into this period of uncertainty and kind of how to navigate it the best way, because honestly, there are so many great opportunities, but you have to know how to take advantage of them. So I highly encourage you to attend that and please share it with other people that would really benefit, especially young people. I'm going to cover a lot of basic life principles when it comes to finances, how to buy a car, how to buy a house, how to manage your money better. Just really simple things, but they make such a difference to your ability to make and manage and invest your money and grow wealth over time. But yeah, the big news is that the Fed has declared war on your savings, and I've been telling you for a while. Look, inflation is dangerous. Inflation's gonna erode your money, and without being kind of Chicken Little skies falling, here it has happened now. I mean, if you look, inflation has been growing for a while now, and it's not always, just so you know, it's not always in the official numbers, because there's certain things that are part of inflation, certain things that are not, but all of that still comes out of your pocket. So here's what I want to share. So basically what Jay Powell has said is, normally the government says that they want to have a 2% inflation target. In other words, the government already tells you, we want money to devalue by 2% per year. That's their target. But what they have said, what's different now in this revision of the policy, is that now it's going to be an average target. Well, what does that mean? In order for something to be an average is where you add everything that's happened and divide it by how many. So in other words, to get to a 2% inflation target, you can have 4% inflation and basically close to zero. When you average it out, that can be 2%. In other words, before, what they were doing is, when inflation started, say you had inflation at 1%, when inflation started to get to 2%, they would try and stop it because it was getting close to target once it got to 2% or even slightly above. Now they're saying, we're going to let inflation continue to run above our 2% target, be 3, 4, 5%, as long as it averages 2% over time. Because what they're looking at it is and saying is, well, maybe over the next 5 years, and they haven't given a time frame, but over the next 5 years, maybe we make inflation run at 4 and 5%, because in the first 2 years it might be less than 2%, and then in the later years it might be higher, or the other way around. It might get really high now, but then it'll slow down over time. So we'll achieve 2% over time, but in the short term, inflation will go up quite significantly. So this is where people get caught out, is because they don't realize how much their buying power is eroded in a relatively short space of time. So why is the government doing this? Well, I want to show you just a quick, I want to share my screen quickly with you and just give you a quick sense of what the government is trying to do. Okay, so the reality is right now, the government effectively is borrowing more and more money to pay for the coronavirus-induced, economic slowdown. So many people are out of work, so they've got to effectively, print more money or make more money. So you've seen the U.S. dollar. If you've been following this, the U.S. dollar has continued to drop over the last weeks. Now, when I was buying, back in March, when I was telling people to get into Australian dollars, the Australian dollar was like 60 cents. Now it's 73, almost 73 cents. I mean, it's gone up so much different. And that's not because Australia's done particularly well. It's because the US dollar started to sink because there's so much more money being printed. And now, because Jay Powell has said we are going to allow inflation to go above that 2% target, effectively what they're saying is we are devaluing the dollar. We're allowing it to devalue. And so let me explain to you just something quickly around interest rates and inflation. So if you think about interest rates and inflation, it's kind of like a seesaw. If you think about kids playing on a seesaw, well, when inflation goes up, okay, what the government is saying is, okay, the economy is heating up. So what they'll typically do is, when they see inflation go up, they will increase interest rates. When they increase interest rates, it makes it more expensive to borrow money and to service existing debt. And so when they do that, then inflation goes down, prices go down, people spend less, People borrow less money because it costs more, right? More of your disposable income goes into paying repayments to your bank or to your any sort of credit that you have. And so then that puts pressure on inflation and sends it down. Conversely, if inflation is very low, what they try and do is they lower interest rates. They say, hey, you know what, let's put interest rates down. And then people are like, okay, well, so it's much cheaper to borrow now. So people borrow more money, they spend more. And so then inflation starts to rise again, right? So right now, the problem the government has is that right now inflation is low. In other words, it's not as high as they'd like it to be, but interest rates are also low. So they can't increase interest rates because they wouldn't make any sense in doing that. But they also can't increase inflation using interest rates as a mechanism because interest rates are virtually zero. And so what they're doing now is printing more money. And by printing more money and by buying government bonds and doing all the things they're doing to rally the stock market, it's basically going to put pressure on inflation because they want it to grow over time. But whilst that is happening, all the people that don't have assets, that don't have houses and stocks and gold and all sorts of other different things, they're seeing the value of their money, all of their wealth, if they're just holding it in cash, erode. And effectively, the buying power that you once had will be reduced by an average, of 2%. But that means that next year it could be 3, 4, 5% as the government continues to print money, because this target here, this inflation target, is really what they're trying to grow. And this interest rate, which they used to use as a mechanism to balance out the economy, is not available to them anymore because interest rates are effectively zero. And so right now what you're seeing is the government trying to push and pull on these levers to get a different outcome. But unfortunately, they're not at a place where they have all the tools that they normally would have in order to be able to move the market in the desired fashion. And so that's why they're saying we will allow average inflation to be 2%, but that really means a short-term pressure on what's going on. And the reality is I think it's going to get better worse before it gets better. I mean, Coca-Cola just announced that they're going to be cutting about 4,000 jobs. A bunch of the banks have said they're going to cut a ton of jobs. The airlines are going to cut a ton of jobs. They're looking at maybe trying to fix some of that. But, the airlines were bailed out by the government earlier in the year. And the agreement was that they wouldn't fire anyone or lay anyone off until the end of September. Well, it's getting to the end of September and airline travel hasn't really recovered. I mean, it's recovered some, but not to the degree that it did, pre-pandemic. And so you've got these airlines with planes that are grounded and they don't need as many staff as they once did. And so you're going to see a massive wave of layoffs coming in the next 3 to 6 months. And so the government's going to be forced to print even more money and do even more, especially between now and the election, to try and stop things getting really, really ugly. And so more and more, we're seeing banks tighten up. Right? Banks are going to lay people off. Banks are cutting credit limits. Right? People that had credit cards, maybe they had a $10,000 limit. Now the banks cut it to a $5,000 limit because they're afraid of what might happen. And so I mention this because, the media will talk about all the kind of the glossy stuff, but you have to look at what's happening in the underlying economy, not just what's happening on the surface level. I mean, you see the stock market's gone through the roof. It's actually made new highs for the year. But when you look at the composition, what is that made up of? Right? There's only a small number of companies, 5, 6, 7 companies that are making up the bulk of that gain. All right. A lot of the other companies, like I've been buying Wells Fargo stock, right? Wells Fargo stock before the pandemic, like right at the crash, was like $54. It's now trading today at $24.50, right? It's less than half of what it was. And there's reasons for that. But my point is it's less than half of that. That has not recovered. It's lost 50% of its value, right? But things like Netflix and Amazon and Facebook and Apple, those have gone through the roof and have become massively bigger than what they were even 3 months ago. Like Tesla, all these big companies, that's what's driven the growth in the market. But that's only a handful, right? But all these bigger companies that are not in the tech industry, that haven't benefited from people being locked in their house, right? They're starting to really lay people off and look at that because they're seeing a longer term economic recovery. And so what the takeaway is out of this is you have to position yourself the right way for inflation. And so these are some of the things I'm going to talk about on Sunday this week. Should you buy gold? Should you buy real estate? What should you do at this point in time? And there are so many factors to this that I want to share with you, and I will during that session. But really, this was more about just saying, hey, like, now is the time to really educate yourself and to start to pay attention to what's happening in the markets, pay attention to what's happening with the economy, because inflation is going to start to really roar over the coming, 1, 2, 3 years. And if you're stuck on the sidelines, you're not just going to miss out on opportunities, but you will also end up losing the real purchasing power of what's available to you when you hold cash. The other thing that is interesting is right now, Wall Street is raising a bunch of money, right? A bunch of money. Basically, one in every $5 right now that's being raised, right? One in every $5, right? At the moment, it's about 24 billion with a B, that's been raised in what they call special purpose acquisition vehicles. What is that? It's basically companies saying, we expect there to be huge opportunities in the market, massive carnage in all sorts of businesses, all sorts of companies. And so they're raising cash from investors, they're holding it. And when the problem really hits, when things get ugly, they're going to swoop in and buy at a cheap price. And normally, Wall Street has some of this here and there, but they have done 3 times more at the moment than what they did last year. In other words, a lot of large corporates and a lot of large companies are going to struggle in the coming period. And so they want to be cashed up and ready to go in order to be able to take advantage of that stuff. So I've been talking to some people, and I might put something out there for people that want to participate in something like that. We may look to put something like that together. It'd be interesting to see. But anyway, that's a side thing. But the point is, there is a lot of money, a lot of smart money, sitting on the sidelines waiting because they think something bad is going to hit. Now, I'm not trying to preach doom and gloom, but all I'm saying is there are some markers in the economy and certain things that are hitting companies that maybe weren't apparent before. And so this is going to cause all sorts of shifts, and the people that are prepared and ready and knowledgeable, those ones are going to benefit. And the ones that are not, as with most things, they're going to suffer, and they won't realize it until after it's happened to them. So anyway, I hope this update helps you. I hope it gives you something to think about. And, again, I encourage you to come on Sunday, share it with your friends and family, share it with anyone that needs some good, solid financial education, with some practical things that they can do right now to not just take advantage of the current situation, but also prosper into the future. Thank you. Bless you. I'll talk to you soon.